Currency derivatives are financial instruments that derive their value from the exchange rates between two currencies. They are used by businesses, investors, and financial institutions to hedge against currency risks, speculate on exchange rate movements, or lock in future exchange rates. The most common types of currency derivatives include forwards, futures, options, and swaps. A forward contract is a private agreement between two parties to exchange a specific amount of one currency for another at a predetermined rate on a future date. For example, a US-based company expecting to pay €1 million to a European supplier in 6 months can use a forward contract to lock in today's exchange rate. This eliminates uncertainty about the future cost, regardless of currency fluctuations. Currency futures are similar to forwards, but are standardized contracts traded on exchanges like the Chicago Mercantile Exchange (CME). Futures require daily settlement through a clearinghouse, reducing counterparty risk and increasing transparency. For instance, a trader expecting the British pound to strengthen against the US dollar might buy pound sterling to US dollar futures, aiming to profit if the pound rises. Currency options give the buyer the right, but not the obligation, to exchange currencies at a specified rate before or on a set expiration date. There are two main types: call options, which provide the right to buy a currency, and put options, which provide the right to sell a currency. For example, an importer in Japan anticipating a weakening yen might purchase a yen call option, ensuring they can buy yen at a favorable rate even if the yen strengthens. Currency swaps involve the exchange of principal and interest payments in one currency for those in another currency. These swaps are commonly used by multinational corporations and financial institutions to manage long-term currency exposures. For example, a US-based company with operations in Europe might use a currency swap to exchange dollars for euros, ensuring stable cash flows in both currencies. The primary use of currency derivatives is to manage foreign exchange risk, which arises from fluctuating exchange rates. This is particularly important for businesses engaged in international trade or investments. For example, an exporter in India earning revenue in US dollars may use currency derivatives to protect against a decline in the dollar's value relative to the Indian rupee, safeguarding their profit margins. Currency derivatives are also popular for speculative purposes. Traders and investors use these instruments to bet on currency movements, aiming to profit from price fluctuations. For instance, if an investor believes the euro will strengthen against the dollar, they might buy euro futures or call options to capitalize on that expectation. While currency derivatives offer significant advantages, they come with risks. The most notable is market risk, where unfavorable currency movements can lead to losses. For OTC derivatives like forwards and swaps, counterparty risk exists if one party fails to fulfill their obligations. However, exchange-traded derivatives like futures and options mitigate this risk through the use of clearinghouses.